I think it's a conflict of two opposing forces. And the first force is skipping rungs of the ladder. Okay. That causes unease with people around you. When you're too young to step into certain roles, if you don't have the right presentation of that and you don't have the right energy about you in the right way to handle that with people maybe much older or that don't respect you due to an age issue, if you don't approach that appropriately, then what happens is it makes people uncomfortable and resentful.
Mm-hmm.
For me, I always was going to push hard and I was always okay skipping rungs of the ladder. And again, I had family that put their hand on my shoulders at times. Do you want to wait 20 years to reach a point like this? What's stopping you from doing it now? And again, that came from a mentality of roll up your sleeves and go get it now. And so it's necessary that you have to skip people or you have to get ahead and do that. And it's not about holding people back or doing negative things. It's about you grabbing the steering wheel and you stepping forward. So I didn't know how to present that early on. Today, I probably push a lot more for myself to have more humility and to build people up. And my goal in my company is to give everybody else all the good kudos. I don't want any blame for anything. And early on, I didn't understand that. I would just say that. And now I want to give everybody on my team the responsibility of everything good that ever happens. I don't want to put that on me. And if there's something bad, then the shit falls upward and I take that on my shoulders and figure out how we can do better and ground up the team based on me shouldering that. So early on, there's a way to gracefully deal with a lot of things when you're pushing forward aggressively and trying to drive change, drive growth, drive leadership when you're overly young, maybe underqualified appearing. And if you don't handle that with grace, then it doesn't produce the outcome with morale or with team synergy that you need to really hit the highest levels and things.
Yeah, I love it. I love it. And I feel like you got to a point where there is a humble confidence about you, right? You're able to put yourself in those positions where you're, able to put everybody on your back, but you're also standing in the background, pointing to everybody else and saying, great job. You guys take all of the credit and all of that. So yeah, again, I completely agree. And I think that a lot of entrepreneurs get stuck there. So kudos to you for making it into that realization. So
that's what's worked well for our team. And so I want to stick to what's working and building the others up and empowering the team, because at the end of the day, that talent really takes you the furthest.
Yeah. Yeah. I love it. I love it. So as we were talking before we hit the record button here, we decided that we were going to have a theme around this episode about where to put your money. And obviously this is on everyone's mind. There's a lot going on in the world right now. Why don't you maybe give a little bit of your background to give yourself that support for being able to offer this type of advice to people, like some of the things that you've done before in the past, and just give a little bit of a bio, I guess you could say, about yourself and your background.
Yeah, I think that's a great idea. My background is that I'm classically trained. I started very early with 2 family offices along the way. By the age of 26, I was really running and driving and setting strategy for acquisitions and for the portfolio. So I really dove in. I wanted to be as involved and learn as much as I could very early. I was absorbing books at a rapid pace. I was working essentially nonstop, really throughout all of my 20s. But by about my mid-20s, I was running acquisition and portfolio strategy in the midst of the Great Recession. It was a very complicated time. I was blessed to work with multi-generational real estate mindset and strategies and systems that I could learn from, and I could bring a degree of marketing focus and growth focus and strategy and technology strategy to the groups I was working with at that time. And what I learned, we really innovated, we really did great things and helped navigate a really tough time. But we had one moment that was an aha moment. And what happened was we were buying deals extremely below market. We had great relationships with banks. We were buying some deals 50% off, 50% below replacement costs. And I can brag about how crazy those numbers sound, but they weren't super uncommon at the era post great financial crisis and Great Recession. We bought one deal in particular that was the turning point. This deal was probably 60% off, 60-ish% off of market value. And it looked like a screaming deal. It didn't look like the problems were as big as it looked like mismanagement was the biggest issue, which is much easier to solve than some fundamental issue. And we got in, we rolled up our sleeves and got after it. And what we saw when we really started running the asset was that the market around us was softening more than our early data looked. So the first round of looking at the local market looked like it checked the boxes, but when we really dug deep, we found that it was the opposite. So we ended up exiting that deal and did make money, and it did work out, but we held the deal for longer than we wanted. It was a grueling process, extremely difficult, the most difficult leasing scenario and vacancy issue that we've ever had, still to this day, bar none. And we really got by on the skin of our teeth. What that taught us was that we will never buy another deal. We will never go into another asset class. We'll never go into another market without understanding multiple layers of the economic situation and strategy that goes along with that, which we've built over time. So where we're at today is we joke about being economic strategists. That's really our goal as we look at the markets and find the best opportunities. So that's really my background of where we got today, is looking at the economic levers, making a mistake along the way by only scrubbing a top layer of data. And now we really built a robust platform. So now with Saint Investment, which is the company that I'm CEO of today, we focus on very heavily on economic indicators, economic strategies, and what that data looks like to guide what we're looking at and seeing for the future for the next 10 years plus.
Yeah, interesting. So I guess the platform, if you will, that you've developed and refined over all of these years, you said there's multiple different layers that you want to understand about each one of the cities, markets, MSAs that you're investing in. What are those layers that you want to understand before you would make that type of an investment in a market or in an area?
So what we're looking at is a top-down approach. What's the situation for the U.S. economy, right? Even geopolitics. What's it look like for wars and supply chains and all kinds of things? Because we want to focus on what asset classes have the brightest future, the best horizon ahead. What we found, I could get into all kinds of stuff. I believe that industrial real estate has the best next 10 years of any asset class in real estate. That's our bet, and that's what we believe from our data. I believe that debt and investing in debt is going to replace bonds as strategies for fixed income. I could go into crazy stuff about how I actually believe that crypto strategies can replace a lot of gold investing. But what we look at is top-down approach. What's going on at the big level? The Federal Reserve, what are they doing with monetary policy? What do we see as the future of things like interest rates? What do we see as the future of things like the biggest drivers like inflation, like wage growth, like population growth? And then we chunk down from there. So if we're in industrial, which we are, and that's our focus on the syndication on the asset side, if we're focusing on industrial, we're looking at what are the biggest drivers. We're looking at port volumes, how much incoming, how much importing, how much is being imported into ports, and then where does it go and what routes does it take? We're looking at how much manufacturing is occurring in the United States. We're looking at where those hubs, are they new places that are being built out because they have more strategic infrastructure? Or are the historic cities like the Detroits, the Chicagos, the Milwaukee's really taking the majority of that for a lot of manufacturing? And then we're going to the local economy. We're seeing, is that growing? What's wage growth? What's job growth look like there? How does the infrastructure support it? What's the business climate in a lot of these regions? And then what's that look like extrapolated out and, with future things? So top-down approach, really understanding what we see as the biggest opportunity and then peeling back layers from there.
Interesting. Let's define when we say industrial, because again, this can go all kinds of different types of assets. So what are you defining industrial as? What does that look like for you?
So I keep it vague on purpose because I think a lot of subsectors of industrial are going to benefit. There's some that I don't think are as optimistic, or they're too niche for me to really focus on or for our team to really focus on because they're very regional. The two highlights, to answer your question directly, that I believe will be the biggest opportunity over the next decade. The first is going to be warehousing, just large warehouses where goods are imported or stored for future distribution. So distribution warehouse is number one. Number two is manufacturing. I could get into light, heavy. I can get into breakdowns of that's a little more market specific, but I think manufacturing. And I think the big winners in those two sectors are the the southeastern and southwestern points of the U.S.
Mm-hmm.
And I can go into a million data points and a million drivers of that, but that's what we're looking for on the industrial side, and really what we're seeing as the drivers for the next 10 years of industrial.
Yeah, that's really interesting. And so when you're looking at these areas, you mentioned ports right off the bat. How influential is having a port access compared to, I guess, railway, right? So if you're middle of Texas, is that more or less desirable, would you say, than that being somewhere on the southeastern United States by one of the major ports? Does that come into fact or into play, or?
Texas is a unique market for industrial because there's a few different factors what you're pointing to. You have the port, the Houston port, that's an amazing, great port with great access and has a huge opportunity to a lot of different imports. But that also is supported by an amazing infrastructure through the Texas Triangle, right? So you have San Antonio and you have Houston, you have Dallas, you have Austin right in the middle of that. And you have just a freeway system that just goes straight through it. Mm-hmm. So it's so powerful. It's such a driver for growth in general for the U.S. And then you have the port system, and then you have Mexico to the south, okay? Which, just to be clear, Mexico's our largest trade partner in the U.S. They surpassed China in 2023. So with that being said, you not only have an amazing growth opportunity in Texas, but now you're dealing with nearshoring for manufacturing. It's great. I think U.S. manufacturing will boom, especially whatever you think about the Trump tariffs. I probably have a lot of comments both directions on that, but the Trump tariffs are significantly trying to boost U.S. manufacturing, okay? The flip side of the tariffs are it still might be cheaper to manufacture in Mexico, depending on where this all shakes out, because it's down the street from South Texas. It's down the street from Southern California. So these factors, cheaper labor, I've seen the studies, I've seen different charting showing that Mexican manufacturing per manufacturer, per employee, per labor is cheaper than China today. And China's still on the upswing of labor costs since 2000 of 15 to 20x increases. So I'm super bullish on the U.S.-Mexico relationship. I'm super bullish on what that looks like for manufacturing and the future of distribution there. And tariffs or no tariffs, I think the Mexico-U.S. trade partnership is still going to be super solid. So I think we should be I think we should be as close to that relationship as we can when you're dealing with things like distribution warehouses, because there's a lot of things to warehouse and distribute.
Yeah, that makes perfect sense. And obviously focusing in on close distribution from those border areas like you outlined, that makes perfect sense. So with all of that gives a great outlook on your background, where you came from, and all of that. Let's jump into what people should be looking at, what people should be doing today. Where should they be putting the money? Just getting back to what we originally set the intention for this podcast to be today. So in your opinion, and you're using all of your insights, what is something that someone should be absolutely considering today as a location or a place to be able to invest the dollars that they might have sitting in their bank?
So I look at a few things. The first thing is to look at what we used to do. I think that's a good place to start. Let's talk stocks and let's talk the equities markets, okay? S&P 500, you can look at Dow Jones, et cetera, et cetera, et cetera. Just to oversimplify it, if you look at the New York Stock Exchange, since 1995, the New York Stock Exchange has reduced the number of companies by over 40%. Mm-hmm. So any way you cut that, there's a pretty massive reduction in stocks. So on one hand, we might say maybe they got stronger, right? Look at the stock market since 1995. It's been booming overall. Okay, maybe. But what we know for certain is that if stocks go up and there's less companies, then there's actually less distribution. There's less diversification in the market. And if you look at the chart of like the top 7 stocks, top 10 stocks, top 5 stocks, right? The Nvidias, the things that make headlines constantly, it's way overrated. It's way overweighted. The distribution is very little. We're overweighted in the stock market dramatically. If you look at the predictions of some really big groups, you've got things like Goldman Sachs saying that they expect average equity returns per year for the next decade to be at 3% or less. Okay, that's Goldman Sachs. That's not doomandgloomchronicles.com, right? Like we're talking huge financial analysts, huge teams that are saying that they see 3% returns per year. Now, we can talk a different angle, which is things like the biggest drivers in the economy, good and bad. Right now, I see inflation being a huge question mark. Inflation's at mid-2s today. I think that's artificially suppressed, candidly, but let's say it's mid-2s. That means that if stocks are at 3% and Goldman Sachs is right, and inflation's at 2.5 on the way up the last handful of months, then you're looking at best at a 0.5% return per year in those two scenarios combining. So all that to be said, what we really see as a bigger trend, what we really see as the bigger movement of the market is what we're starting to scratch our heads and talk internally about, the everything bubble 2.0. The everything bubble, just to wind the clock back to a handful of years ago, the everything bubble was this weird time when inflation was relatively low, but everything was expensive, right? Everything was going up. Stocks were going up. Real estate was going up. Everything was on its way up, but still inflation was low. We believe from what we've seen in our data that those are the early indicators of an inflation cycle, a debt cycle, kind of a debt upward spiral in a negative way. Other people have said things like the market is crashing upward. Other people have said things like instead of a market melt down, we're dealing with a market melt up. So to define that, hyperinflation, prices through the roof, government, really lack of government control of the market like we've seen. We're seeing that the Federal Reserve is in a position where they only have so many levers, right? They can reduce rates, they can do quantitative easing or tightening, but they already tried the rate thing recently, didn't they? And what ended up happening was rates didn't go down. They reduced rates and didn't see that because the market's smart. We live in an open market situation where treasuries immediately went up. So the bigger question in this environment is what's causing it, and then what can we do about it? So that's the background a little bit, but I'll stop there and check in with you and see if you had any questions on any of that.
Yeah, I actually haven't heard of the market crashing upward or that type of a spin on essentially hyperinflation is what I was picturing this as. Can you dive in a little bit more and maybe outline what life might look like in that type of a scenario, right? Like just giving some real world scenarios or real world examples of what life could look like in those situations?
Absolutely. So let's say we're in a settled market, just a neutral market, and then you throw in hyperinflation. Okay. What would typically happen is the Federal Reserve would pull their first lever, which would be to raise rates. That slows down the market. Inflation typically comes down a handful of months later, let's say 9 to 18 months later, you start to see real meaningful responses to the inflation and to the trends from there. That would be great. That would be a great scenario for what we're looking at today. The issue is hyperinflation is the core. So you understand economics, you understand the cause of what that would be, like a great melt up or a great upward spiral in a bad way kind of thing, a market crashing up. The issue is there's multiple factors that are causing an inflationary trend. And I could drill down into multiple, but the biggest thing that we're seeing, the biggest trend that's pushing this today is that we don't have a good response to the national debt crisis. We as a country right now, as a snapshot in time, we make 4.5 trillion coming in GDP, right? We spend 6.5. So our tax revenues are, government inputs, our government income, 4.5 trillion. We have spending of 6.5 trillion. The shortfall of 2 trillion per year goes immediately on top of the debt. What we're looking at is our debt spiraling to where it's about to cost us about $1 trillion a year. And that's on top of discussions at the highest level, whether it's Trump or Harris. And we know that Trump won, just to set in stone the time frame of what we're looking at. But both candidates were very clear that all of their strategies very likely added to the deficit. They actually created a bigger negative. So at the end of that, we have a cycle where we overspend as a country. We print money to then pay the debts. The debt increases. The debt burden then increases. We have to print more money to pay for those debts that we can't sustain. And then inflation is caused by more of that printing money. And then that cycle goes out of control, right? So it boosts the cost of everything. We all high five each other because the S&P or the Dow just hit a new record. But in reality, the net effect to us as consumers, to the American population, is that life is getting worse. People can afford less. Small businesses have a tougher time. The economy is in a more difficult situation. So there's only a few ways to tackle that. But we're also dealing with trends like supply chain question marks. If tariffs are implemented at a very high level in a big way, what that looks like. If we do bring manufacturing back to the U.S., which is my bet, I really believe that Trump is pushing for that. I think that's generally a good thing, but that's freaking inflationary, right?
Yep.
You're doing all kinds of different infrastructure projects. Those are inflationary by nature too. You have baby boomers phasing out. They're taking their money with them. They're being replaced by Gen Z, which is a tiny generation by comparison. So all of those things have very inflationary upward pressures that limit what the Federal Reserve can do, limit what we can do on the back end, and put the consumer and the investor in a weird place where they got to make decisions on one side, dealing with inflation that's just chipping away at the value of their dollar. And then on the other side, finding out what the best opportunities are, because they got to do something. They can't sit in cash. They can't maybe not sit in the stock market. Maybe treasuries aren't paying enough. So it's a tough time for investors. And that's really what we're trying to lean into at Saint, is to give investors the tools.
Yeah. Interesting. And I love how data heavy you are with all the backup to get all of these. This is just a very high level overview over all of this, because these could be day-long conversations diving into all of these different topics. So I guess, again, getting back to the main point, what is an investor supposed to do today? Where should they be putting their money and looking for these investment returns that aren't going to yield a 0.5% after you take out the inflation and all of that other, the other economic drivers that might be pushing the returns down?
So the advice I'd give investors, the considerations I'd give investors are two categories. The first is fixed income, and then the second is appreciation. So historically, that looked like stocks and bonds, right? Bonds were the fixed income, stocks were the appreciation side. Today, I encourage investors to consider that the markets have changed. I suggest they look at the markets that the previous ways of doing things don't work today, because just if you look at the results, they're not compelling, they're not interesting, and they don't give investors enough meat on the bone for the risk that they're taking in the marketplace. So what do we do with our money? Kind of what you and I were going back and forth with before, which is the number one question. You have to look at things that thrive in inflationary environments. What actually benefits from inflation, so that if you're going with an inflationary trend or upward trends in rates or upward, et cetera, if things are going more expensive, more difficult, higher priced, how do you actually invest with that? That's the number one question. What we found as the number one answer in both categories, fixed income, and for appreciation, it's bar none, it's real estate, right? You know this, Matt. I know you're very sophisticated. Your team kills it on the real estate side. I know you guys kill it, especially in multifamily. We see the same trend being taken advantage of in a positive way by investing in real estate. So if you buy a real estate asset and it's in the right market and you're doing the right things and you have the right team to execute the game plan, then it's likely that will actually go up with inflation or maybe more, right? Because as markets shift and things happen and prices go up, the best assets seem to do the best. Real estate on the appreciation side. Now, I can say that, what we talked about earlier, I believe the best drivers, the best wins are in the sales of industrial by far. But there's a lot of reasons behind that. On the fixed income side, if an investor's looking for something that's longer term, that's going to be, or excuse me, that's shorter term, a little more liquid, a little more flexible, and they're looking for something that's a little more stable they can depend on, I believe debt is the strategy that's the best opportunity moving forward, investing in debt. What we see at Saint as the number one opportunity to invest in debt in the marketplace, the number one fixed income opportunity is the mortgage investment side of single family homes. The reason being, the single family market is so impacted right now. It's so tight. There's so many bids on so many properties. And even though that's slowed down a little bit, that's due more to rate increases than it is to fundamental problems in that marketplace, right? You're dealing with mortgage rate increases of over 111% since the beginning of COVID, which means a huge chunk, we estimate 40 to 50% of homeowners can't move because they can't afford the jump to a new property, which just creates such a locked in great environment. So investing in those mortgages where people don't really want to move, they can't afford to move because of the rate hikes, the rate increases from maybe their 3 or 4% previously, is so locked in. It's so stabilized. So the debt on that. And then on top of that, the assets, the homes also appreciate. So if you have a mortgage on an asset that's appreciating, the homeowner's equity is increasing. The likelihood of them not paying goes down dramatically. So that's the number one opportunity we're seeing in the fixed income space right now.
Yeah, that is interesting. And this is an asset class that I don't have any experience in or really much exposure to. But one thing that comes to my mind was, right, like you explained, like I'm in this situation where I think my mortgage is like 2.8%, right? We're like, do we move? Then we're going to have to pay a higher interest rate. Well, let's not move. There isn't any point for us to move. So we feel like we're stuck in that particular situation. But that loan was obviously made, I think it was in 2020, 2019, something like that. So that loan has already been made, created, I'm assuming sold off. Is there a way to be able to get into this cycle, if you will, of investing your money into being able to participate in some of those locked in type situations? Or is this debt opportunity more for new loans and moving forward? And obviously everything you mentioned, appreciation is happening. Things are getting more expensive. Interest rates are going to probably go back up again, which is going to make it more expensive for people to get involved. So I'm just curious from the I guess just the flow of how that particular market works. Like, how do you get involved with that? How does that work?
Great question. So the number one question being, what does an investor do with their money and how do they do it, right? How do they execute that?
Right.
The number one way that I see to invest in mortgages specifically, the number one way, because it seems like this nebulous, yeah, that's a corporate thing. I'm not Bank of America. It's inaccessible to most people, it feels. The reality is there are funds out there that do the work of acquiring these mortgages and pay a fixed income rate. So we're obviously, clearly, I'm not shy about saying that I think we're the best at it, but we have competitors that are fantastic and do the same thing for their fixed income funds. So what these funds do is they work with banks, take a Bank of America or a PNC or Chase or whatever. And these banks have huge pools of loans that they originate, these top 5 banks especially. Their job is to originate and create loans. They're really good at it. They make the fees, they make a lot of the front end stuff, and that's what they're great at. And then they package these loans, these pristine, perfect, on-time paying loans, and then they sell to someone else, a pension fund or a sovereign wealth fund, something that just needs minor return. The loans that they originate that might have some payment issues along the way. Maybe COVID happened and they missed a few payments, but now they're paying again, so they have a rolling balance. Or maybe they missed a couple months because there was something that came up in the family, like an illness or something on the minor scale. Typically, what you'll see is that they set those loans off to the side. Those are called non-performing loans. Those are called underperforming loans, rolling balances, et cetera. And then they deal with guys like Saint Investment Group, and we buy those at a discount. And we get with the homeowners, we get them paying again. Oftentimes it's as simple as a phone call and getting in touch saying, why aren't you paying? Chase Bank wants to foreclose on you. but we're calling you to try to work this out. Why aren't you paying? Oh, I can only afford 2,000. I can't afford 3,000. Okay. If we were to extend your loan by X amount of years, but drop your payment, does that keep you and your house happy? You keep your equity, your family safe. Are we good there? Yes, yes. Great. Let's get this show on the road. So that's one side is fixed income funds. There are debt fixed income funds that are out there that are fantastic. Our competitors are great. I think our fund's amazing. I have a ton of money in our own fund because I can't find a better opportunity on the fixed income side. So for accredited investors, I would tell them if they want to invest in fixed income that's based on real estate underlying assets and real estate debt, there are those opportunities out there for them.
Yeah, that is really interesting. Talk a little bit about your fund. How large is it? How much longer is it going to be available? Are you going to make another fund when this one is full? Talk a little bit about that.
Sure. So we have two strategies, like I said. One is the fixed income side, and then one is the appreciation side. It's more of the syndication side for the sophisticated investors out there. We want to give our investors a growth opportunity and a fixed income opportunity. So as the market ebbs and flows, they can attack the market from both sides and really create a lot of stability and diversification. So when you invest in a fixed income scenario, like the same income fund, you got to have diversification. You got to have a lot of assets that back that up. Otherwise, an investor's better off maybe doing it themselves or looking somewhere else with more diversification. So we have over 500 mortgages in that fund. We're in over 21 states so that we're not market specific. We're not concerned about one market's hiring process or local economy. We basically are betting on the U.S. economy overall over a long period of time, specifically the single family market. Lots of diversification. We pay pretty great returns because we buy at good discounts. Our upper end of the spectrum is 14.28% fixed income, fixed return, all the way down to we have really flexible options as little as 6 months for the initial term. And once the initial term's done, investors can get their money back in 90 days. So all they got to do is put in notice on that. They can keep it in for 5 years. They can keep it in forever. They can get it back right away in 90 days. So the purpose of an income fund is flexibility and dependability of the assets paying the same return every month. So we pay out monthly. On the other side, on the syndication side, it's a little bit more strategic when we enter. So we only work in several key markets. We're focused on the industrial side. We're focused on growth. We want high growth levers. We're looking at things that are very stable. Historically, our IRR averaged about 35.5%. So really crazy numbers. But today, in this market environment, we're expecting to go for things a little more conservative. We do think there's a significant upside. We think 20 plus is very achievable in a lot of markets, especially in the future of industrial. So that's what we're looking at on both sides. I'd say to investors, the number one goal early on in your investing career is to work through two items. One is if you're accredited or not accredited. If you're not accredited, get accredited. Because the amount of access that you have to next level investing it just goes up exponentially. Your opportunity goes off the charts. Yes, it means you got to make more. Yes, there's other ways to do that, getting a series license, but get accredited because you have access to so many more opportunities. And the second thing for investors is, do you want to do it yourself or do you want to invest with professionals? There's not a right or wrong answer, right? It really depends on the individual. And we ask that on nearly every phone call when someone, hey, I'm considering investing. We're like, how hands-on do you want to be? Oh, I don't want to be hands-on. Great. This might be a good opportunity for you. I want to do it all. Then really you got to roll up your sleeves and get in there because we are a hands-off, done for you investment opportunity. So between those two things, I think people have great opportunities if they can answer those and see what their portfolio needs, whether it's growth or fixed income.
Yeah, I love it. I love it. Yeah, this is, again, there's so many different avenues that we can go down. We're already almost an hour into the recording here. I feel like this is a good place to stop with this. And let's jump into the life crafting segment. So again, just really quickly to recap this in case you haven't heard this before. This is a process that I go through every Sunday where I lay out my weekly goals and then the action steps to be able to achieve those goals. I realized that I was speaking to all of these amazing entrepreneurs and very experienced and successful people. And a lot of times I was guessing on what it was that I felt like I needed to do to be able to achieve whatever the goal was that I wanted to achieve. So I thought, let's ask all of these amazing guests that we have on the show what their highest ROI activity is that they have in their life and learn from them, right? So Nick had some really interesting insights when I asked him that. Nick, what is your highest ROI activity that you feel you have in your life?
I believe that strategic, quantifiable, tracked growth, being addicted to growth, is the number one skill that you can have in your life. For me, the categories are health, wealth, and legacy. So in each one of those categories, I am tracking, I'm looking at exactly what the next steps are to take those categories to the next level. For health, right now I'm powerlifting. So it's really easy. I see what numbers I can lift and I try to bump those up in the categories I'm tracking. For wealth, it's bringing Saint to the next level. It's growing our funds. It's innovating more. It's looking at the next projects. It's growing our team and making sure that they're in the right places. I'm really happy with our progress year over year work. We crossed over 200 million in assets under management. We have a big year ahead. So that's the wealth side. And then the legacy side, it's typically, I focus on my kids, man. I have 3 sons. So I try to be very involved. I try to give them everything I can. I'm always identifying the next way that I can give them more and give them more opportunity to be the best version of themselves. So sometimes they need more stimulation on physical sports. So we're focusing on jujitsu right now for them. Sometimes it's education, trying to give them new outlets, like whether it's coding camp for computers, et cetera. Each of those categories, health, wealth, and legacy, it's always finding what the next level is, being addicted to hitting the next level for that, and then finding the next level of growth from there. And that to me has been the single biggest strategy in my life.
I love it. And just to get a little bit more tactile, are you using spreadsheets or some type of tool? Is there one like central hub where all of these things are all being tracked and everyone involved can log in and take a look and see where they were last week and where they should be this week, right? What does that look like for you?
Sure. So I used the strategy of setting the week on a Sunday, like you're describing that. I think that's a great strategy. For longer term goals, longer term trends, I lean into something called the 12-week year, more or less. It's a book. And it's the idea of don't plan for a year, plan for a quarter, more or less. And what that does is it breaks down to weekly goals. You know what you're doing to achieve those. It's flexible enough that you can say at the end of the quarter, hey, we need to change the focus here for the next quarter. You don't have to wait a whole year. Maybe your goals or your strategies are stale 6 months in, you're not forced to stick to those. So I really like the 12-week year. We use it as our team. We focus on quarterlies quite a bit. And then we have long-term goals like 3-year, 10-year, et cetera. But that week by week planning strung together for a quarterly goal to a bigger picture. That's how I string things together to keep an idea of what's the 6 inches in front of my face versus what's the bigger strategies, et cetera.
And how about the opposite side of that? So I forget who it was. Someone wrote about the whirlwind, the daily shit that happens, like where you get distracted and all of this stuff is pulling you in all of these different directions. How do you go about prioritizing, again, keeping on track with where your goals are and yet still being able to do something with the whirlwind?
I love it. I use a tool called Toggle. Okay.
Yep.
And what Toggle does, I'm sure you're familiar, you're nodding your head. Toggle it's a time tracker. And I keep the categories very simple. I have asset management, I have growth, I have personal, I have family, et cetera. And so I track which categories for my family and for my life and for my business are being used by what time during the week. And so when I wake up 2 days later, I know, wow, I spent way too much time here. I did not spend enough here. Wow. I know what my threshold is for growth versus asset management. I need to be spending more time on this versus that, and seeing if things are in line with what I want them to be, right? If I'm doing things correctly for Saint, I owe it to my team to be growth heavy and to be pushing forward and to be implementing new systems to take us to the new level, right? That's where I fit in for our company strategy and culture. So if I'm not hitting that, then I can look at the numbers and it quantifies it for me. And that goes for the personal side, that goes for everything. So just being able to see that data, and it does it for you. You click a button on your phone, right? So that data overlaid with things where I'm looking at quarterly goals, looking at the weekly steps to take there, it really just takes the thought process. And are you motivated? It's who cares if you're motivated? Stick to what your plan is and you'll get there. So
Yeah.
I try to take a lot of the emotions out of it. I try to lay out whatever. I'm extremely busy. So if I'm not that organized, things will fall through the cracks. So my goal is to eliminate a lot of the slack in strategy or in scheduling.
Yeah, I love it. I love it. Nick, this is, there's again, so many different insights and we could go in all kinds of different directions with this. So really appreciate your time here today. If people want to learn more about you or the fund or just learn more from you, what would be the best way to follow you or reach out and get in touch?
So I had a great strategy, or excuse me, I had a great conversation with you, Matt. I really enjoyed it. I love diving on these economic topics. We do webinars that are hour long, 90 minutes long, deep dives on strategy, what's going on in the economy, a bunch of great topics. All those can be found for free at saintinvestment.com/resources. Our next upcoming webinar is on the Great Melt Up, which is the topic you and I just went over. We'll show the charts, we'll show the graphs, we'll show the strategies behind it, we'll show the causes, the history, et cetera, and what the future may hold for, the debt spiral, the hyperinflation, the government spending that we talked about today. We go through a lot of other topics as well. So all that's for free at saintinvestment.com/resources. And our goal is just to educate investors about what's going on. We're already doing the research. So if we can give back in an educational way, that's really fulfilling for us.
Beautiful. Yeah. I'll be tuning into that and checking some of that stuff out. Again, it's always great having a plan and knowing what's happening, why it's happening, rather than just, I don't know what's going on or what's going to happen next. So great to be prepared there. Nick, again, many thanks. And this is a great episode. Again, thanks for all your insights.
Matt, I had a blast. Talk soon, my friend.